What's up, everyone? Welcome back to the New York City Multifamily Podcast. I'm here today with Lonnie Hendry of Trepp. Lonnie is in from Dallas today. What's up, Lonnie? How you doing, man?
Doing well. Good to see you.
Yeah, this is going to be fun. So we've got a lot to talk about today. I'll give the audience maybe like a little agenda of some of the things we'll cover. I think most people know Trepp for your podcast. You guys put out like an unbelievable podcast. I'm envious and I'm coming for you. No, so I want to hear more about like what Trepp does, who your ideal clients are, some of the products and services that people rely on you for, what you want to grow into more this year. And then we'll get into like some interesting data points because you guys are unbelievable with data around trends all across the country and different market sectors. I want to hear more about like what's happening in New York versus other parts of the country and CMBS, Fannie, Freddie, and then regional banking distress and how you think that's going to play out. And then we'll get into like some fun wrap up surprise questions for you.
Yeah, sounds great. Looking forward to it.
So why don't we talk a little bit about like what is Trepp? How did you guys get started? Like walk the audience through a little bit about like what you guys typically do.
Yeah, so Trepp is a commercial real estate data analytics provider. We were founded in 1979. We really started off as a commercial real estate and structured finance consulting firm. And then in the early 90s, BlackRock took an ownership interest in Trepp, and it kind of coincided with the starting of the commercial mortgage-backed security market. So as they created this new asset class or tradable security, they needed to create some market transparency or market awareness around the underlying collateral, which in this case was a bunch of commercial real estate properties and mortgage loans. So Trepp was actually written into the reporting structure for all of these loans. So where we got our inception in like the structured finance world really was in the early 90s. Somebody goes and takes out a commercial mortgage-backed security loan on the property. Trepp gets all of the underwriting essentials at origination. So we'll have trailing 3-year financials, who the sponsors are, who the lender is, who the special servicer is, all of the stuff at origination. And then we get ongoing surveillance of the property performance for the life of the loan. So most CMBS loans are 10-year terms. So we'll actually get updated line item, income and expense, owner operator supplied financials every quarter for the full duration of the loan term. And then we get monthly performance data. So if they made the mortgage payment, if they didn't make the mortgage payment, if there's a floating rate interest rate, we'll know when the rate resets and what the benchmark is. So like very granular, and we have that data going back to the 90s. So we've built this immense platform on top of it where we now can do aggregations, forecasting, all kinds of stuff. We model out default, probability of default, loss given default. We have a whole suite of products built on this 30 plus years worth of owner submitted financial data.
That is unbelievable. So this is like crazy inside baseball.
For sure.
And is this public, or like if I'm a subscriber, is it effectively public?
Yeah.
How do you share that?
If you're a subscriber, you get access to it. There are some deals that are private. You have to be a qualified institutional investor to get access to it. But there's a lot of deals where the data is public. Obviously, being written into the deal structure makes that process a lot easier because we're a recipient of all of the data. And we were since day one. So we've been able to create products and services and insights and analytics that just others can't replicate because we've been getting the data since the inception of the market. And so over the last 10 years or so, we've really doubled down on the CRE space. We've brought in some subject matter experts and practitioners from the field and really pushed ourselves into the CRE landscape so that we can help users pretty much with any CRE use case, whether you're a lender, a broker, a tenant rep, a landlord rep, a lender, an appraiser, whatever the case may be. We have a solution that helps you do more deals, become more efficient, make more money.
Yeah. So I like that. Yeah. Everyone who wouldn't like that. So you're really catering to like any segment of the market. You're basically are you like basically trying to be the number one source of information in the commercial real estate market across the country? Because that's kind of what I'm hearing.
Look, in a perfect world, everyone would have access to Trepp, and we'd be powering everyone's workflow and helping them do more deals. It's a competitive market, and as you know, I mean, real estate is an opaque entity where it's still a relationship business. I think at this point in 2025, it's much more data-driven than it ever has been. But you still have a lot of brokers and a lot of folks that do deals at lunch with handshakes and their network, and that relationship is never going to go away. We're really trying to find that niche where we can supplement the relationship, make their network larger, make those conversations a warm call instead of a cold call, that type of stuff. So yeah, if we could be in everyone's workflow, like that would be amazing.
You're taking us out of the Stone Age, you know.
Yeah,
the real estate industry very much, like, in a really weird way, like it's kind of archaic in a sense where, like you said, like it just gets done on a handshake, or like it's more of an art than a science. So,
you know, it's interesting. I think the COVID actually accelerated the use of data and technology because you couldn't go to lunch with people anymore, and you couldn't meet at happy hours and events. And so
in Texas you could.
You're right, and we did. And Florida, same.
Yeah.
You know, and it's interesting if you look at origination volumes and you look at activity during those years. Florida and Texas were like knocking out of the park, and a lot of that was due to the net in migration that both those states saw, where they basically made a proclamation like, hey, we're open for business. People moved there, and activity has been off the charts. So, you know, for us, if we can make people's jobs better, make them more knowledgeable. And I think the other thing that's helping, you know, this integration of tech and data into the workflow is the people you serve, the people that are like maybe not practitioners, but they're owner operators or they're in the business. They're starting to look at data a lot more closely as well. So it used to be, hey, I know a broker, I've worked with him for 10 years. If he says this or she says that, it's good.
Mm-hmm.
Now it's like, we're going to trust you, but we're going to verify what you're saying is actually happening because it's a lot more competitive. So we have a lot of people that are on the periphery of CRE that are now using our data to just kind of get insights around their own market understanding and knowledge growth around the CRE landscape.
That's interesting. What do you think the average broker across the country, whether it's a sales broker or a mortgage broker, what service of yours do you think is most applicable to them that is kind of like a no-brainer for them to subscribe to?
Yeah, so our flagship CRE product is called Trepp CRE. It's something that everyone in CRE should have access to, because what we've done is aggregated at the loan and property level all of the details we know about every property in one platform. And we also track balance sheet loan data there. We track a bunch of other non-securitized, non-CMBS data there. We've built some proprietary models so you can get a directional proxy for value on any property in the U.S. All you have to do is type in an address. It'll pull it up. We have a proprietary pro forma model that will use the 30 plus years worth of CMBS data that we have to derive income and expense synthetic operating statement for any property. And again, we're not calling it an AVM. We're not saying that it's 100% perfect, but if you're a broker looking to make a cold call to someone to see if they're willing to sell their property, we're going to give you a really close proxy for what the value of that asset should be under normal management conditions.
Do you ever get like some of the owners who are like, why does everyone know my business? You know what I mean? Like, does it bother people? Do you ever get any of that type of feedback where, you know, now it like you're putting a lot of sunlight on people's business, which is good. I think sunlight is better.
Yeah, I think it's like anything else. You have some people that are like, wow, this is amazing. I didn't realize that my value had gone up this much, or I had this much equity in the deal to try to get out of and maybe reposition. You have others, like you're saying, that are like, I don't want anyone else to know what I have, and I don't want anyone looking that close to what I'm, you know, how I'm operating my business or whatever. It ebbs and flows. I mean, I think at the end of the day, we've all kind of adjusted to this information society that we live in, where everyone can find out a lot of information about anybody, just with some web research or whatever. So, you know, for us, we're trying to provide factual, you know, actionable information in the marketplace. And none of the stuff that we provide obviously is personal. It's all building and property specific. And, you know, we're looking at property performance. And so it's, you know, we think we have a pretty good offering in the market for that.
Yeah. Do you get like, are you involved? Like, does the government, is Big Brother watching? You know what I mean? Like anything, like, do you have any like government regulations or anything like reporting or anything like that with?
I mean, we've provided data to members of Congress on request.
Wow.
And, you know, for me personally, this last year in 2024, I had the opportunity to go into Washington, D.C. and meet with a senator from Michigan. And they had seen us on CNBC. We had done a segment on some distress in the market, and so his aides reached out. We scheduled a trip up there, so we got to talk through what we're seeing in the CRE market. So nothing like direct where, you know, any information from us is going to them on the regular, but we work with a lot of government entities. We work with a lot of private sector folks. I mean, that's the one great thing about where we're positioned is just data drives the market.
Yeah.
And at this point in 2025, I think data and information is really the new currency. And so we try to get that in front of as many people as we can to help inform, because people can make better decisions if they have better data, and better decisions usually lead to better outcomes. And that means everyone's winning.
Interesting. If you were a representative from the landlord industry in New York, how can we use your information to spell out to the legislative powers that be here? How do we draw it in crayon for them so they understand how challenging of an environment we have here in New York? Is there anything that like maybe you would say or recommend for people?
I mean, I think listen, where it gets a little nuanced is when you start talking about political motivations, those in most instances are not necessarily data driven. I think we could help paint a picture of some of the challenges that the regulations, the rent control, rent stabilization have created for New York. I would suggest that New York is a great example of a bad example, right? Of how they've really suffocated a marketplace and kind of choked out opportunity at some level. But generally speaking, the folks that are in power were the ones that initiated that type of legislation. So whether you can point it out to them with data or not, it's very hard to change their opinion.
So I'm in, first of all. It's really amazing. I wonder if I have a couple of thoughts. So I wrote a letter to Governor Hochul like the other day about, and I like, you could submit something on her website,
Sure.
whatever, and who knows if she reads that stuff or not. But some of I published it publicly, and some of the feedback I got was like, Seth, you're missing the point. Like, this was actually intentional. This is, and which is exactly what you're saying. I wonder if like, the industry could contract you, so you could put together like some type of presentation for the powers that be. But that's another conversation. Let's get into maybe some trends that you guys are noticing. You want to start New York City? You want to start national?
Yeah.
What are you guys noticing?
So
what keeps you up at night?
Yeah. So we put out a monthly delinquency report where we track national delinquency statistics across the U.S. by property sector. Overall delinquency is over 6%. We've, steadily been increasing in delinquency over the last 12 months or so.
This is multifamily.
This is
talking about
total. Overall delinquency is about 6.5%.
Every product
for
type,
all property types
across the country.
Start parsing those out. Office set a new high watermark this last month in December at 11.01%. We'll have the January data here in the next couple of days. But that was the previous high water mark was 10.7% back in 2012 for office. Now it's at 11%. So it's stolen most of the headlines nationally around delinquency.
What's normal?
1.5.
Oh, wow. Okay.
I mean, like we're at some multiple of normal, 10x on the office, and overall delinquency is usually in that 1% to 2% range on the running history
for everything.
And we're at 6 plus at this point. So. The Fed's actions on interest rates and just uncertainty coming out of COVID and some of the other just work from home paradigm shifts that we've seen in the market have really put some downward pressure on the property sectors. But you can look at it two ways. And I do a bunch of presentations throughout the U.S. and it's really interesting. Like in life, if someone said to you, 90% of something is going to go your way and 10% is not, you would probably feel pretty good about that. So in this case, 90% of the offices are paying, 10% are not. But when you're an office owner and you're part of that 10%, you're in a challenged spot. You can't refinance. There's some real, headaches. So I think you got to have some perspective with this. Multifamily, as an example, multifamily's climbed up over 4.5% nationally on the delinquency side, and that's just for CMBS. So excludes agency. Fannie and Freddie almost, very low delinquency, less than 1% still on the government-backed stuff. But on pure CMBS multifamily, it's over 4% nationally.
Huh. Jerry Seinfeld's most important word in the English language. Do you know what it is?
Let's hear it.
Perspective.
And
which is exactly what you just said.
I'm becoming a huge believer of that. As I get older in life, I'm realizing perspective is incredibly powerful. And a lot of people view things at face value and they don't actually get the context, or they don't do a little bit of due diligence to gain the perspective. And it's challenging in some regards. And I saw a stat the other day that said 85% of people will believe something they've read, even if it's been proven to be false.
That is crazy,
It's
right?
crazy.
What is that?
And so
what's wrong with you people?
It's interesting how information, and we talked about being in the digital age and where Trepp sits in the ecosystem. We have to be careful what we put out in the marketplace because people will believe what they read, And so these headline delinquency numbers, they're all factual. They're all at an elevated pace considered when you look at their historical norm. But just for some context, the peak delinquency for all property sectors was July of 2012, coming out of the GFC, was at 10.34%. So we're at 6.5% now. So we're elevated, but we're nowhere near where we were coming out of the GFC. So I think all things relative, we're still in a really strong market cycle right now relative to what we were during the last disruption.
Interesting. What about, do you have anything on like the multifamily?
I do.
Delinquency?
Yes, let me pull up. I brought some stats with me here. So if we're looking at the New York MSA, right now for multifamily, there's $1 billion worth of delinquent loans. So,
sounds like a lot, but it's New York. So is that a lot?
It's a lot. It's a lot on a dollar amount. It's only 6.7% of the New York MSA. So again, more than the national. The national average was 4.5. Mm-hmm. We're at 6.7 in New York to the tune of $1 billion. But we have a really large market in the New York MSA. Like right now, we're tracking just about $97.5 billion worth of outstanding multifamily debt in the market.
$97.5 billion outstanding.
Outstanding.
And how much of that is set to mature in 2025?
So we've actually seen increased maturities in 2023, 24, and 25. I don't have the exact figure on the multifamily, but it's sizable. We estimate between now and 2020. I think in 2025, there's about 950 or 980 billion, depending on how you calculate it, in total maturities in 2025. Multifamily and office comprise a large portion of that.
What do you think is going to happen?
The same thing that's been happening.
You got your crystal ball.
Yeah, so this is what
nothing? Or?
Yeah, I think, look, borrowers and lenders are incentivized to try to get deals done because the borrower is fighting for their equity or their investor's equity. Lenders don't want to take back properties that are non-performing because if a professional operator can't operate it or can't sell it, the likelihood of them doing any better is not great. So I think what you've seen, and this is subject to maybe a change in position from the regulatory or the regulators. Right now, the guidance has been if you have a borrower that's willing to work with you as a lender, the regulators have said work with the borrower. So we've seen an increase in modifications, extensions, all these things. I think we just see that into 25. So we were joking on our podcast the other day about, what do we think 2025 is going to be? And everyone's heard the survive till 25 or whatever. But I heard some guys saying we're just going to see more of 24. And I think the first couple quarters of 25 will basically just be kind of like 2024. You're going to have some fringe properties that are totally not performing. Those are going to get sold off. People are going to, distance themselves from those. The properties that are kind of like on the cusp, lenders are going to try to work with them. Borrowers are going to fight for them. Now, if things don't change dramatically, if interest rates stay the same, if there's not a renewed sense of appetite for investment, the second half of 25 could be challenging, or it could be really great. I think if we see any type of consideration given to interest rates, which the treasury yields have not been favorable, even though the Fed's cut rates. But if we start seeing any reprieve at all on the interest rate side, I think 2025 could be a really, really strong year. People are ready to deploy capital.
I feel like it.
Yeah.
You know what I mean? Like just year to date, like you feel like people are ready to spend money and do something. There's been like this pent up demand. How does this, how do these workouts or level of distress differ between CMBS, Fannie, Freddie, and then regional banks? Because in New York, we do all things multifamily in New York. Like we have a huge regional banking presence here, and everyone is kind of looking around like when is the shoe gonna drop? You know what I mean? Like they're not really able to sell the loans. Like the velocity is down a lot. So how does maybe these workout scenarios differ between those types of three different lens?
Yeah, so I think it's a great question in the sense that all three of those are slightly different in the way that they approach both the initial underwriting and origination, and then how they deal with distress throughout the process. In the CMBS world, it's super covenant driven. So you default, there's literally like a contract that says if borrower defaults, here are the 6 things that are going to happen.
This is black and white.
Black and white, no relationship. It doesn't matter.
You're calling like a 1-800 number if you have a problem.
You're calling in the servicer. There's third-party consultants that will help you with that. Like it's very much like, what do your loan docs say? And what we know in life is most people don't read the docs. They sign the docs. They close the deal. Everyone's going to win, and no one ever imagines that their property is going to go default or whatever. So it's not until they get to that point that they realize I'm in a pickle. So in that instance, it's very much prescriptive. Like if you're in a CMBS loan, here are the next 3 steps. It's not until the last minute where the lender realizes maybe I'm going to have to take a loss on this, or the bondholders are taking a loss on this, that they try to do a workout. But in that instance, they're incentivized to generate the best return for the bondholders they can. So in most cases, as a borrower, if you're willing to pledge additional cash, if you're willing to do some things, they'll work with you. But it's not until all these other remedies have been exhausted, your cash gets put in a cash trap or a sweep, and so any excess cash flow they get to keep, like all these things, right? On the GSA side, or GSE side with Fannie and Freddie, similar but a little bit different. I mean, like generally speaking, most of their loans are for stabilized properties on the front end, conservative leverage. Like I mentioned, delinquency for Fannie and Freddie is under 1%. So it's not really been an issue for them relative to some of these other property lender types. And then the regional bank, very different. You have relationships with the borrowers. They generally have deposits at your institution. You have a vested interest in their success at some level. So you see regionals working a lot more with the borrowers on a one-to-one basis to try to extend, modify, do what they need to do. So that's where the excitement comes. Like for me, as someone in the data space, it's great seeing how all of that comes together to create a CRE ecosystem. Now, New York, you just layer in all of this administrative red tape and all of this rent stabilization, rent control for the multifamily sector, that a lot of that wasn't in place when some of these loans were taken out. And so to your point, like there's not a huge appetite for some of these assets in New York where they would have been if you didn't have this additional regulation. But right now it's really challenging. And so we've seen with some of the banks that failed here in New York, I mean, there were some rent control, rent stabilized components of their portfolio that like nobody wanted.
Yeah. What do the bondholders say about rent regulation or like something in some type of distress when it finally gets to their desk, God knows how many months later, when they have to pay attention to it? Like, what's their appetite right now? What are they thinking?
I mean, I think, look, all investors are wanting a return on their capital, return of their capital, and they have optionality in where they place their capital. So if you're telling me that I have the ability to put my capital to try to earn revenue in something that has limited upside based on statutes and regulation, or I can place that capital into something that's free market driven, I'm probably leaning towards that side of the equation. And, we've seen an influx. I mean, you look at where all of the multifamily investment has been over the last 5 years, large portion of it has been in the Sunbelt states that are very pro-business. They don't want rent control. In fact, some states have actually created legislation outlawing rent control because that creates at least a perception of upside for investors. And so I think New York, that's the one thing that, to your point earlier, and if I were to give a presentation to the elected officials, I would be adamant about the fact that not only are you're capping the rents and the upside for current owners, but you're really limiting additional investment dollars coming to this geographic location because they don't want limited upside. The best thing you can do as an investor is you can buy a property that's underperforming, you can reposition it, and you reap the benefits of that reposition on sale. Almost in every example, they take those proceeds and they immediately reinvest in another property.
Yeah.
Which just makes that local economy stronger. It employs people. It does all the stuff that you need a local economy to do. Here, it's different. If someone's able to sell out of a property, they're probably moving their money to some other state and buying a cash flowing single tenant net lease deal or something like that.
Yes.
Instead of trying to manage all the headache that they have to here in New York.
Yeah. At what point is there a brokerage opportunity in the distressed loan world? Is it like, because the process takes months, if not years. Like, at what point should brokers be involved? At what point, is it wasted energy for the average broker to be kind of trying to, stick their nose in there a little bit and facilitate some type of capital event? Like,
I think it's
any sense?
Yeah, it does. And look, it's like any other part of brokerage. You got to be all in you can't dabble in it and hope to have success, because
Right.
there are firms, there are individuals that's their entire business. And so they have the relationships. As soon as the lender has some inclination that a property is going default, they immediately reach out, they get the BOVs, they get all that stuff with the brokers that they know and trust.
Right.
So they're like, yes, there's definitely enough opportunity for that to be a viable business. And if you're in that business, like, you should definitely be on the phone with those lenders every day. And I'll tell you, for folks that were making those calls 2 years ago, the lenders were saying, we're in good shape. We have really low leverage. These deals are great. Like, yeah, interest rates are up, but we're not in a position to sell. Don't have any distress on the books. They've definitely changed their tune over the last 6 to 12 months, where they're like, okay, we have some pockets, we have some properties. Now, the discounts have not been substantial, but we've started to see a lot more transaction flow where lenders are willing to offload properties.
Yeah.
So I would suggest, if you're interested in that space, there's definitely a need for it, and there's definitely opportunity, but it's just like any other part of the brokerage world. You got to be on the phone. You got to foster those relationships. You got to be part of it every day.
What would you say to a lender listening to this in New York City? Word to the wise to a New York City lender.
Don't wait. I mean, like, you should be well versed on what the market actually is for the properties that you hold as collateral. So if you lent money on a rent stabilized apartment and you were at 55% loan to value at origination, the value has definitely come down. The cap rates have gone up. The perceived value and upside for an investor coming in is considerably different today than it was then. Don't wait until the last minute to find out what that value is. Like, you should be proactive. You should be reaching out to brokers in the market and getting a sense, so that if and when the time comes and that loan matures, you're in a position to make a good decision to say, maybe we extend this property, it still is low leverage on a relative basis. We think there's some upside, whatever. Because if not, you're going to end up where you're trying to become an expert in these rent control, rent stabilization laws at the wrong time when there's a maturity. You're going to have a borrower that's saying and doing everything they can to protect their interest. And you're going to be in a really tough spot. So the best thing they can do is just get educated. And I think in New York, that's a challenge, just because it's so, like, you live this. You would be a resource. If I'm a lender, I'm reaching out to Seth and I'm like saying, Seth, educate me a little bit on this, because it's hard to kind of put all the pieces together unless you're working in that space every single day.
It's so nuanced in New York. It's like really crazy. People ask me all the time, like, well, what's the market like? What are cap rates like? What are their, price per foot or whatever? I mean, it could be anywhere from 5 to 9.
Yeah.
Like, that's how crazy it is right now. Yeah. And, this is a good opportunity to like transition into like maybe some sales data around what's happening across the country. So in New York, last year, our team sold 97 apartment buildings, and they really ranged from, a 4-unit free market apartment building for a couple $1 million to a $97 million portfolio sale in Chelsea to an exchange buyer. And the pricing numbers and the rents, and it's all over the place, and it's just so nuanced. But what's kind of happening from a national level about multifamily cap rates? Are they still 6 or below 6? I know it's so nuanced, but like, generally speaking, are you still seeing sub 6% cap rate sales?
Yeah. So in our data, I pulled it up before I came over today. Weighted average trailing 12-month cap rate for multifamily nationally is 5.55%.
That's unbelievable. Because in New York, it's at least 100 basis points higher than that. And my partners and I are screaming on the rooftop thinking like, this is the greatest opportunity. Yeah. We are probably by far, I mean, I'll ask you, like, the highest cap rates in the country. So that's what it feels like.
It's nuanced, like you said, because New York is just difficult to paint a broad brush picture just because of all the different regulation. If you have a conventional complex that's not subject to, New York is still super attractive, and there's a lot of people who will still buy on a really aggressive cap rate and pay a lot of money for it. There's been so much new construction and new supply added across the country nationally that a lot of the cap rates, I think, are betting on upside for lease up and stabilized rent growth that maybe they just haven't been able to achieve. But yeah, I'm surprised at how sticky the cap rates have been on a national basis. I mean, you look at interest rates, in almost every instance, a lot of these deals are day one negative leverage, and they're hoping to increase NOI. But the challenge is, like, Rent growth nationally for the last couple of years has been hovering between -1% and +1%, depending on who you trust, what data set.
So effectively
flat on rents, right? Well, what we know is the inflationary pressure on the expense side has not been flat. Property taxes are up, insurance up significantly, repairs and maintenance, just your overall cost to operate up significantly. So if you're flat on the revenue side and your expenses are up, your NOI is going down, not going up. And interest rates are going up, so your cost of capital is higher than it was. So the multifamily space, it has some really strong believers in the space, and I'm one of them. Like, I'm very bullish on multifamily long term. Like, I think we have a shortage of affordable housing in the U.S. Multifamily, for all of those that maybe are a little bit nervous because the delinquency's up or whatever, it's all valid. But they, again, going back to perspective and context, we added about 1.3 million new units nationally in 2023 and 2024. That, to me, is what's negated the rent growth and kind of made it level off. Once those units get absorbed, we're going to see the pendulum swing back. I think 25, after the first half of the year, you're going to start seeing some pretty hefty rent growth numbers in major markets. And once that rent growth starts to pick back up, you're going to see renewed effort of placing capital in a multifamily asset. So maybe that's why the cap rates haven't expanded as much as I thought, because people are kind of looking at that construction pipeline in 25, 26, 27, 28, and like, it's minuscule compared to what we just had from a delivery perspective. So the next 4 to 5 years, I think the pricing power is going to be on the favor of the landlord in the non-rent stabilized, non-rent control market.
And then that's when we see cap rates compress when once at like the beginning or middle of the rental cycle, when people can pro forma in their model rent growth. Right now, it's kind of hard for people to pro forma rent growth, but that's kind of amazing. But that's why people are paying 5.5 caps, because some of them are aware of the supply constrained market and upward pressure on rents. This is really interesting. What are some of your anecdotal observations about New York City right now?
I mean, I think so. I'm based in Dallas. I'm in New York 1 or 2 weeks a month. I think just from a vibe perspective, the city is pretty much back to what it was pre-COVID. Like, I mean, I think if you walk around the city, it feels very much like it did pre-COVID. I think the office market in particular is primed for a really strong rebound. I think 2025 is going to be a pivotal year for office. I think we've seen the City of Yes initiatives. We've seen all these things where they're trying to develop housing. You're going to see a lot more office to residential conversions. I think there's something like maybe 97 started in Midtown, and maybe the surrounding boroughs. Like, that's good news for the market. I think for multifamily, look, it's the same. It's like, to your point, you're going to see this, cap rate range, sales price range on a per unit basis that varies just based on the regulations that are in place. And I think, for some New Yorkers, they own properties outright that's been in their family for some time. So the regulations diminishes the value for them over the longer holding period, but they can still cash out today and still have capital to reinvest.
Yeah.
Hopefully some of that money stays here. I'm bullish on New York. I'm bullish on, look, I think Chicago, LA, San Francisco, New York, like all of these cities, if you're looking at the next 5 or 10 years, everyone's going to be kicking themselves that they didn't buy as much real estate in those markets as they possibly could during this disruption.
Right now, like in these cities that you're mentioning, are prices like kind of generally depressed? Are they mostly consistent with each other? Are they operating on the same type of curve?
So what I've seen in the last couple of quarters, maybe the last year, is, and my conviction has gotten stronger in this, I think you can have a market that has increased distress, delinquency, and bargain basement prices, but you can have within the same city a market that has increased transaction activity, velocity, and increasing sales prices. And that's where most of these are. Like for Class B, functionally obsolete office buildings in most of these major cities, guess what? There's no saving grace for those today. There's going to have to be a reset in basis. So you're going to see these low price per square foot deals come on market. But for every one of those, there's a really strong Class A, highly amenitized building that's pushing rents that's actually worth more today than it was 2 years ago. And the transactions support that. I think multifamily is in a similar spot. Like if you look nationally, there's been about $175 billion worth of CRE CLO, so short-term floating rate bridge loans taken out on multifamily, or 150 billion, call it plus or minus, over the last 6 years. About 70% of that's dedicated to multifamily, and about 70% of that is in the Sun Belt. So there's these floating rate deals where people are cash strapped. They are inexperienced syndicator type of investor. There's going to be some real buying opportunities for some of those multifamily properties that didn't hit the pro forma.
Yes.
But it's such a small percentage of the overall multifamily market that it's hardly a blip on the radar. So listen, what we both know, real estate by definition is a local, sometimes hyper-local endeavor. And it doesn't matter what interest rates are, and it doesn't matter where we are in the cycle. There's always properties that are opportunistically priced where you can buy at a good basis and make profit. And there's always properties where you see the sales price, you're like, how the heck did they get that price? It doesn't pencil without fail.
Yeah, it's so, yeah, I'm in. You're 100% right. We have a lot of clients, like you were saying, about like these private clients, buildings been in the family for generations, in New York, and I would guess these major cities across the country, like LA and Chicago, like our housing stock is just old.
Yeah.
Like we just have, our cities have been maturing for decades. So our housing stock is old, therefore the maintenance is high, compliance is high. But we have a lot of private clients who want to sell, can sell, but they have a tax problem and they don't know what to do for an exchange. They're not necessarily 100% sold on buying a triple net lease, or they don't have necessarily the capabilities to go buy, a 200 unit apartment building in, Texas or Florida, right, or whatever. And they're nervous, right? They've never done it before, and it's scary. What would you say to the average New York private client who is thinking about a different asset class that's maybe like a little easier, like retail or net leases? Like, what's the general health of that industry or the businesses that operate in that industry in 2025?
Listen, I think in the retail sector broadly, we've joked on our podcast and in a bunch of my presentations that we've gone from the retail apocalypse to the retail renaissance. So there's been a lot of publicity given to these local strip mall type of retail properties. Occupancies at an all-time high. Rental rates are at an all-time high. There's been a real renaissance in the retail space. So I think people should look at retail. A lot of the fundamentals are very similar to multifamily from an operations perspective, but instead of maybe 200 tenants in an apartment building, you have 6 tenants in a strip mall. But same concepts, right? But you get the security of longer term leases. You only do build out once every time the lease rolls over. Like there's some security there, but you're still not hedged, or you're hedged a little bit from having just a single tenant risk. So like these smaller community strip centers, I think are really good options for folks to transition, where some of the underlying operational skills they have for multifamily translate to retail. On the single tenant, triple net lease stuff, I mean, look, that's a little scarier for some people just because there's a lot of headline risk there. So you've seen the Walgreens, you've seen the CVS, you've seen these folks that used to be viewed as like super safe investments file bankruptcy or downsize their footprint, et cetera. But for every one of those, there's a Dutch Brothers, or there's a auto collision center or something else that's like popping up across the U.S. all over the place. So I think people have to be willing to look at what those opportunities provide, and the headache factor for those can be a lot less than some of the regulatory stuff on the multi side. Yeah. And this is where I would say, look, like they should be talking to you and others where you can provide that understanding and perspective. It's not as scary of a jump as people probably imagine. But if you don't have the right data, you don't have a professional that can explain it to you and kind of walk you through the upside, I could see where people might be a little bit hesitant.
Yeah, totally. All right, let's get into some like fun wrap up and prediction stuff. Surprises are coming. All right, if you were the GP of $100 million multifamily fund, how would you allocate that money?
Yeah, so look, I would stay in Florida or Texas, probably, maybe Georgia. I'd stay warm weather cities, pro business. I think there's still opportunity in the higher end multifamily stuff across the U.S. We've seen a propensity of people to not want to rush into buying homes. The longer term prospects, I think that plays positive for longer term prospects for these like higher end rental communities. I would even say maybe some of this horizontal multifamily stuff with the build to rent, single family rental. I would be very interested in looking at some of those deals in these less bureaucratic states where the data suggests some of these build to rent single family developments, They get a rent premium, sometimes as much as 10 or 15% on a monthly basis. They have more stickiness, less turnover. The maintenance and operations is a little bit challenging, but I would say, look, Sunbelt multifamily, even though the headlines would tell you that that's where all the risk is, I still think based on migration patterns, economies, et cetera, weather, that's where the growth is going to continue to be.
And that's where
I'd be bullish down.
You would be bullish.
I'd be bullish.
You wouldn't put any chips like on the dip in New York or LA or Chicago, whatever.
I mean, listen, about $100 million, I probably would allocate some to those.
Yeah.
I think it's a little bit of asymmetrical risk at this point because there's not been the political shift that I would want to see. Now, maybe we're seeing it in San Francisco where you've seen them, start penalizing people that rob stores and the theft and the stuff like the life quality issues are getting cleaned up there.
I can't believe that's the bar, by the way.
It's crazy, honestly,
Yeah.
But until those things get cleaned up, I would be hard pressed to want to go and make investments today. Now, it might sound a little contradictory to what I said earlier. I think in 5 to 10 years, all those cities are back to where they were.
But you want to see that flush
but
out.
I want to see a little bit of a sea change in just how they administratively operate their cities before I be placing a bunch of capital there. Now, if you can find something that's significantly reduced on a cost basis, okay, then you definitely would look at it. But I think all the demographic data points to just strengthening economies across Texas, Florida, and the rest of the Sun Belt. Even North Carolina to some extent, pretty strong markets there. Be interested to see what happens.
Interesting. What's your big contrarian bet in 2025?
I think
regardless of product.
Listen, if we're sitting here at the end of this year and we're talking again,
Cowboys are gonna.
I'm not gonna listen. Every year.
We won't go there.
I mean, I think at this point they should have hired me to be the coach. It's gotten so bad. I am a lifelong Cowboys fan. I'm a child of I was a kid in the 90s. I remember going having Super Bowl parties, and that's just what you thought football season was. And it's been 30 years now, and it's
you don't just get to win every year.
Yeah, it's challenging. So I'm one of those I'm still a fan, but I know I'm going to be disappointed. So that's not a contrarian take. That's just facts. Kind of like the Jets fans here. And so,
wow. All right.
But I would say the office sector. I think we're actually poised to see some major players make some decisive moves in the office space in 25. I don't think it'll be in the first 2 quarters, but I think the latter half of 2025, you're going to see a huge sentiment shift in office. It's driven primarily by some of the executive orders that were signed this last week with the return to office mandate at a federal level, and that coinciding with DOGE, where they're saying we're going to eliminate some of our government inefficiency. I think the weighing of both of those creates opportunity to push the government workers back in the office, or if they don't show up, they're going to sell their buildings. And that's going to create buying opportunity for folks if they have to sell. But if government workers are back in the office at scale, guess what? The private sector is going to force their folks back to the office. So I think the latter half of 2025, you're going to see a pretty strong comeback for the office sector. That's my contrarian take.
I love that. That's interesting. All right. You teach at Texas Tech, I think, right?
Yeah.
What are some of the most common misconceptions you think young people have about the real estate industry? You probably get some pretty hilarious questions.
Oh, it's funny. First of all, if anyone says passive income in a real estate context, or mailbox money, those are terms you'll hear. And when you're trying to sell someone something, those are terms you might use at some level. But the reality is, even if you're on an absolute net basis and the tenant's responsible for everything, there's still some headaches that come along with just operating any entity or any endeavor, any business, right? So understanding that real estate is a very hands-on business. People's lack of understanding of the role data plays. Obviously, I'm a data guy, but you can't just kind of stick your finger in there and say, oh, I think this is going to happen. You need to have some data to support your positions. And I think for students today, the biggest challenge and the biggest thing that I try to instill on them is you don't get paid for what you know, and knowing isn't doing. And in today's day and age, people are afraid to get in front of a room, tell people what they know, take action. And if you're willing to do that, by definition, you're already in the top 1 or 2% of your cohort because everyone else is afraid to do it. So if you're trying to get in the commercial real estate space, you have some advantages if you're a student. People will take your call if you're a student. They could walk into your office today and say, hey, I'm a student at Fordham. I'd love to see kind of what you guys do a day in the life of a broker. And you would set them up with someone, or you would walk through the office with them yourself. But if they come in 6 months after they graduate, you're not going to have time to do that. It's just a different connotation. So while you're a student, you got to take advantage of those opportunities. You got to put yourself out there. And look, we're a relationship business. Everyone's in sales and real estate. Even if you're not in sales, you got to learn to sell yourself and keep going, man.
That is probably some of the best advice actually that anyone's given on the podcast to young people. When you're a student,
yeah,
like people just want to help you.
100%.
But
like,
the day after you graduate,
it's a different.
We don't give a
different
you.
dynamic.
You know?
I mean, like when I was in grad school,
right.
I was in grad school. We had to do some projects on some complex financing structures. So we went to like HFF back when they were in business, and like walked in. They brought us into their CEO's office. We signed some non-disclosure agreements that we're going to use this for academic purposes. They walked us through like 3 deals. Like within half an hour, we're like talking to someone, seeing real deal docs, going through the process. Only because we're students. If we were not students, that would not have happened. And so it's something I really enforce in my classes. And I also tell the students too, and this is something I'll say, it's hopefully some students that hear this will take this to heart. Create a professional portfolio for yourself while you're a student.
What do you mean by that?
So when you're taking classes and you have to do a project, or you're taking classes and you have to go and you have to interview someone, put that on a blog, create a website, do something that codifies that. So when you go into an interview and you talk with someone, everyone's going to have a college degree. Everyone's going to have some network connections. They're going to have whatever. But drop your business card off and say, I put together a professional portfolio while I was in school. And here are the last 10 projects that I did, where I did a discounted cash flow analysis, or I did these things. And that person that interviews you can go to the website and they can see those things in real life. Again, it shows them what you know instead of you just telling them what you know. Huge game changer.
Wow. That is like some really, really good advice. Wow. I feel like I'm a student. I'm like really learning. This is awesome. All right. Last 2 questions here. Your favorite car to drag race.
Okay, so I have two
Found that on the internet.
Yeah, I have 2 1968 Dodge Darts. Something me and my dad have done since I've been a little kid. I've been in the drag strip my whole life. Like my parents had pictures of me like sleeping on the hood of his truck when I was like a little kid, me and my brother. So I have 2 1968 Dodge Darts. I love them. I drag race them all over the South, Texas, Oklahoma, Arkansas, Missouri, Kansas.
Oh my God.
All over the place. Me and my dad go all over. And so yeah, 0 to 110 miles an hour in about 6 seconds, 3-foot wheelies.
Oh, sick.
Incredible. It's like, it's an adrenaline rush like no other. So if you're ever in Dallas, I'll take you for a ride in the car.
100%.
And we'll do some stuff.
That's awesome.
Yeah.
What's one thing the audience should know about you that they can't find on the internet?
I'm a little bit eccentric with my eating habits. I don't eat very good. I don't eat fruits or vegetables. I like steak and potatoes or Italian food. And so that's pretty much what I eat all day, every day. And so
you get along well with my kids.
You know, so the joke is like we go to a restaurant, they have to get a kid's menu for me, you know? And so it's like I eat everything plain and dry too. Like tacos, meat and cheese only, hamburger, meat and cheese only. Like I'm not interested in the condiments. So, yeah, so that's, you know, I'm a little bit nerdy. I'm definitely type A perfectionist. And if you work on my teams, we subscribe to this moniker of #team whatever it takes. And I believe that with everything that I am. So like if you're on my team or you're in my family, we're going to do everything we can. We're going to do whatever it takes to be the best, period.
I love that.
And so that's what it is. You know, like we live in a world that wants everyone to be status quo. I don't want to be status quo. I want to be the best. Yeah. And I may not be the best. You know, I may end up 2nd, 3rd, 4th place, but I'm going to do everything I can to be the best. And everyone on my teams are going to be the best. So if you're listening to this and you're interested in working at Trepp or you want to reach out or whatever, love to talk to you. But just know that like if you're on our teams, the standard is high and we're going to push to be the best.
I love that. All right. And all the audience, make sure you guys check out their podcast, the TreppWire, right? On Spotify and Apple.
Yeah, it's everywhere. The TreppWire Podcast. We just rolled over 300 episodes. We're about 304 episodes now. And we started March of 2020 and have not missed a week since. Comes out every Thursday night.
What's the best way for people to get in contact with you or your team?
Yeah, so they can look me up on LinkedIn or go to our website. They can email me. It's just Lonnie_Hendry at Trepp.com. And love to interact with folks. I mean, that's part of my business at Trepp is making sure that we're explaining and helping and showcasing what our capabilities are to people in the space. And we come from the business. I'm 25 years in CRE, started off in multifamily property management, did some development work. Like I love multifamily. So if you have a multifamily bent, love to talk to you, but we track all property types. Love to hear from people. And hey, I want you guys coming for us on the podcast too. Like it's good. listen, we live in a world where there's an abundance. We should all have an abundance mindset and try to help each other grow and do better.
The pie is not finite.
100%, man.
Like, let's work together to grow the pie so everybody succeeds.
Agreed.
Everyone succeeds.
100%. Yeah.
That's awesome. Well, Lonnie, thanks. This was super insightful and fun. Thank you very much.
Yeah, thanks for having me. Appreciate it.